Welcome to the deep dive.
Yeah.
There's just so much information out there, especially around company earnings. It's easy to feel swamped.
Absolutely. It's a data deluge.
So we're here to be your shortcut. We cut through that noise, grab the essential insights so you can get really well informed, fast, find those surprising facts.
Exactly. We do the heavy lifting, distill it down, find those aha moments so you really grasp what matters.
And today we are diving deep into Tata Technologies Q1 FY26 financial results.
Right. And for folks who might not know them inside out, they're a big player in global engineering and digital services.
Yeah, they help other companies think automotive, aerospace, industrial machinery, basically innovate and build better products. Kind of the brains behind the scenes for a lot of cutting-edge stuff.
That's a good way to put it. And for this deep dive, we've gone through, well, everything. The official earnings call, all the detailed financial reports, the investor presentation, the whole stack.
We read it all, listened to it all so you don't have to. Our mission today, unpack their key numbers, get a handle on the challenges they faced, but also highlight their strategic wins.
And look ahead, right? What does it mean for them? And importantly, what does it signal for the industries they serve? We're pulling out those crucial nuggets.
Okay, let's get into it. The big picture first. Tata Technologies Q1. Well, it came in a bit below expectations, shaped by some unexpected complexities out there.
Yeah, softer than anticipated, I think, was the general feel. So the headline numbers, total operating revenue was INR 12,443 million. That's about $145.3 million US.
And the key thing there is the sequential movement, right?
Exactly. It was down 3.2% compared to the previous quarter in rupee terms and down 4.6% if you look at it on a constant currency basis. So a noticeable dip quarter on quarter.
Okay, so revenue dipped, but profitability.
Yeah.
That's got a bit more nuance, doesn't it? The EBITDA margin contracted to 16.1%. That's down.
It is down, yeah, something to watch. But interestingly, the net income, the bottom line, was actually up 5.1% compared to the same quarter last year.
Up year on year.
Yeah, hitting INR 1,703 million. That gives them a net income margin of 13.7%.
So help us unpack that. Revenue down sequentially, but net income up year on year. What's going on there? Is it cost control, mix of business?
It's likely a combination. It definitely suggests pretty strong operational discipline. Even with lower revenue, they managed costs well, or perhaps had a more favorable mix of projects from a margin perspective compared to last year, maybe better collections too.
Right.
And what's really interesting is how management framed it. They came right out and said they believe these Q1 headwinds are, quote, short-term in nature, largely isolated to just these first 3 months.
So they're basically saying, don't panic, this is a blip.
Pretty much. It sets a tone of forward-looking optimism. They see a path back to growth quite quickly.
Okay, so let's dig into why things shifted. What drove that dip, especially in revenue? Let's start with their biggest piece, the services segment.
Right. Services are the core, about 77% of their total revenue. And that segment saw that sequential decline we mentioned, 5.9% in rupees, 7.6% in constant currency.
And the reason they gave?
Two main things. Delayed deal ramp-ups and just generally elongated decision-making cycles.
Meaning clients were taking longer to sign off or kick off projects.
Exactly. And they specifically pointed to customers exposed to the North American market. It sounds like the newly imposed U.S. tariffs and just general geopolitical uncertainty made some clients hit pause.
Pause or recalibrate their product investments, yeah. So is that purely external stuff hitting them, or could there be internal factors too, like sales execution?
Well, based on their commentary, they really emphasized the external market dynamics. The feeling was more that projects were getting pushed out, delayed, not necessarily lost. Clients waiting for a bit more clarity, maybe.
Okay, makes sense. Shows how sensitive that North American base can be to policy shifts.
It does. But it wasn't all decline. The technology solutions business, which is the other 23% of revenue, actually had a good quarter. It grew 7.3% sequentially.
Ah, okay. So what drove that growth?
Mostly a recovery in their education vertical. Seems like some projects that had been delayed previously finally got going and came online in Q1.
So that diversification helped smooth things out a bit.
Definitely. And speaking of diversification, the aerospace segment was a real standout.
Yeah, I saw that. Up 13% sequentially. That's pretty strong.
Very strong. And it was broad-based success too. Steady demand, solid execution across things like MRO, that's maintenance, repair, and overhaul.
Right.
PLM, product lifecycle management, manufacturing engineering, digital transformation work, just consistent performance there.
So in a quarter where other areas felt pressure, what made aerospace so resilient? And what does that tell us about their overall strategy?
Well, a lot of aerospace work, especially MRO and managing the product lifecycle, isn't really discretionary. It's essential for airlines and manufacturers to keep things running safely and efficiently.
Ah, less cyclical, maybe.
Perhaps less sensitive to short-term economic jitters, yeah. So its strong performance really highlights the benefit of having that diversified portfolio. It acts as a buffer when one sector, like auto, faces temporary headwinds. It's a strategic advantage.
Okay, so despite that softer start, there were definite bright spots and signs of momentum building, right? Especially towards the end of the quarter.
Absolutely. Management highlighted that sentiment improved noticeably as Q1 drew to a close, and crucially, they closed 6 large
The
deals.
6 large deals, define large.
4 of them were over $10 million each, and 2 were in the $5 to $10 million range, so significant commitments.
That's good momentum. Suggests clients were starting to move forward again.
Exactly. It's a key leading indicator. Even if decisions were slow earlier in the quarter, the deals got signed.
And looking forward, they sound pretty bullish, predicting recovery in Q2 and a stronger second half.
They do. They mentioned their deal pipeline is actually stronger than it was at the same time last year. That gives them better visibility, more confidence that they can convert those deals.
And that confidence isn't just wishful thinking. It's tied to what they're hearing from customers.
Seems so. They talked about their 2 anchor customers, Tata Motors and JLR, reaffirming their commitment to new product investment, especially around innovation, electrification, digital stuff.
And that anchor client stability must be huge for them.
It's crucial. But they also said it's broader than just those two. They're seeing overall sentiment improve in the automotive market generally.
Ah, right. They mentioned those latent product investment decisions, the ones held up by elections or EV incentive changes are starting to get made now.
Yes, that unsticking, as you called it, is significant. It potentially unlocks a wave of pent-up demand for engineering services like theirs. Companies that were waiting are now starting to move.
Makes sense.
Plus, they pointed to some encouraging signs on the global trade front, like progress in negotiations, suggesting maybe those macro headwinds really are transitory.
Okay, so the financial picture is one thing, but they also announced some interesting new projects and partnerships. Tell us about those. The Asian airline one, for instance, designing an aircraft docking system.
Yeah, that's a great example of moving up the value chain.
Yeah.
They're designing and deploying this whole integrated system concept to installation. And for an airline, speeding up aircraft turnaround on the ground is huge for efficiency and profitability.
So it's not just engineering a part, it's engineering a whole process improvement.
Exactly, delivering a complete solution.
Uh,
Then there's the win with a major European luxury car maker.
right, supporting body engineering, powertrain, digital, sustainability, and becoming their preferred partner for North Asia. That sounds big.
It's a massive win. Being a preferred strategic partner means you're deeply embedded. You get the first look at new programs, it ensures more predictable revenue, bigger market share, and specifically North Asia. That's a major geographic expansion into a really dynamic market.
So it locks them in more strategically.
Definitely. And similar story with a global commercial truck, OEM, engaged as a preferred engineering partner for a multi-year program.
And they're setting up an ODC for them. Explain what an ODC is again.
Right, an ODC Offshore Development Center. It's basically a dedicated team of Tata Tech engineers working exclusively for that client, acting like an extension of their own team, but located offshore.
For cost efficiency and focused expertise.
Precisely. Mechanical, electrical, embedded systems, all handled by this dedicated center. It really cements the long-term relationship. And speaking of recognition, Volvo Cars named them a top 10 strategic supplier. That's another strong endorsement, especially in software-defined vehicles and sustainability.
And they're looking further ahead, too, with alliances with National Instruments and Emerson, co-developing validation and digital twin solutions. Why is that so critical for this whole AI-driven industrial transformation?
Because this is about building the foundational tech. NI and Emerson are leaders in testing, measurement, automation. Partnering with them lets Tata Tech create tools for next-gen validation. Think sophisticated digital twins, virtual copies of real factories or products.
So you can test and optimize virtually.
Exactly. Drastically cuts down physical prototyping, speeds everything up. Combine that with AI, and these systems can learn, predict failures, optimize themselves. It's the infrastructure for smarter factories, smarter products. It's really core to the future of manufacturing.
Makes sense. And that BMW joint venture, BTIPL, still performing well.
Extremely well. They said it's ahead of schedule, expected to hit over 1,000 employees well before year end, and it's already contributing financially, added about 13 crore rupees to pre-tax profit in Q1.
Wow, so 5.6% of pre-tax profit already. That's significant.
It really is. Shows they can execute these complex, high-value JVs successfully. It's a great proof point for attracting other major clients looking for that kind of deep partnership.
Let's talk EVs for a second. There's been some narrative about adoption slowing down, but Tata Tech seems to think it's just a temporary pause.
Yeah, they're quite firm on that. Temporary pause, not a structural reset. Their conviction seems rooted in the technology trajectory.
Like the cattle battery example they gave. 520-kilometer range, 5-minute charge.
Precisely. Innovations like that tackle the big hurdles: range, anxiety, charging time. They see the fundamental advantages of EVs remaining strong, and these tech leaps making them increasingly viable. Their role, as they see it, is being a strategic enabler, providing the engineering to make it happen.
Okay, and finally, their push into smart manufacturing and AI, deploying things like PLM, ERP, MES.
Yeah.
But the big one sounds like their proprietary AI framework, Chromosome AI.
Yes, that's potentially huge. They're deploying it at 100 plants for a Tier 1 North American auto supplier.
100 plants, and the goal is
Accelerating manufacturing throughput, increasing uptime, especially on older legacy equipment.
so how does an AI framework actually do that in the real world?
It likely uses machine learning to constantly analyze massive amounts of data from the factory floor sensors, machine performance, schedules, quality checks, everything. It learns patterns, identifies bottlenecks, predicts when a machine might fail before it does.
Predictive maintenance.
Exactly. And it can optimize production flows in real time. For that auto supplier, it means fewer breakdowns, faster production lines, getting more out of the equipment they already have. That's a serious competitive advantage. Cuts costs, boosts output. It really positions Tata Tech in the thick of industrial AI.
Okay, let's switch back to the financials for a moment. Operational efficiency. That EBITDA margin contraction they mentioned, operating deleverage. Can you break that down simply?
Sure, operating deleverage happens when your revenue falls, but your fixed costs don't fall as much, or at all. In their case, a big fixed cost is their engineering talent, their people.
Right, salaries.
Exactly. So revenue dipped in Q1, but they made a strategic choice not to cut deeply into their engineering teams. They protected that capacity.
Anticipating the rebound.
That's the idea. They chose to keep the skilled engineers on board, even if utilization was a bit lower for a short period, so they'd be ready when demand picks up in the second half as expected. It squeezes margins temporarily, but avoids the pain of trying to rapidly rehire talent later.
A strategic trade-off then.
Oh,
And the long-term goal is still that 20% margin band.
that's what they reiterated, yeah. Through things like cost optimization, more offshoring, using AI internally for productivity gains. So this Q1 dip is seen as part of managing capacity strategically.
And workforce numbers. Headcount down slightly.
Yeah, down about 237 people net, around 2%. They called it a calibrated hiring approach. But importantly, even with that small net reduction, they're actively hiring in strategic areas.
So trimming in some places, investing in others.
Exactly, investing in high-priority skills, digital engineering, embedded systems, AML transformation. It's about reskilling and refocusing the workforce on future needs, making sure they have the talent for software-defined vehicles, AI projects, cybersecurity, etc.
And attrition.
Ticked up slightly to 13.8% on a trailing 12-month basis from 13.2%, but they said it's within manageable bounds and they're focused on retention, especially for those key future skills, through training and development.
Okay, last piece. Financial strength. They're still debt-free.
Yep, still debt-free. And they ended the quarter with a solid net cash position of $159 million. That's even after paying out a $55 million dividend in Q1.
Impressive. And collections look good, too. DSO at 87 days. What does that number tell us?
DSO, days sales outstanding, at 87 days means they're getting paid by their clients pretty quickly, roughly within 3 months on average. That's healthy. Shows good cash flow management, solid client relationships.
So strong cash, no debt, getting paid on time. That gives them a lot of stability and flexibility.
Absolutely. It underpins their ability to invest in those growth areas we talked about, develop new tech, and ride out any lingering market bumps is a strong foundation.
So let's wrap this up. What's the big takeaway for you, the listener? It seems like, yes, Tata Technologies hit some headwinds in Q1, mostly external stuff.
Right. Challenges they see as tactical short-term, not a change in their fundamental direction.
And underlying that, the strategic path looks pretty strong. The deal pipeline is robust. Anchor clients are committed.
And their focus is clear. engineering a software-defined intelligent industry, helping clients engineer a better world. It's not just a slogan, it reflects where they're putting their resources. Automotive shifts, aerospace innovation, smart manufacturing.
So here's something to think about as we finish. This deep dive, it's not just about Tata Technologies' numbers. It's about how companies like this are fundamentally reshaping things.
The technology they engineer touches so much.
Think about how you drive, how goods get shipped, how things get made. This software-defined future they talk about. What parts of your own life might it change? And beyond that, what new possibilities for innovation, for efficiency, could emerge across all sorts of industries because companies like Tata Technologies are driving this transformation, often behind the scenes. What's the next big leap enabled by this kind of engineering?